This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Some kids get to ask what they want for Christmas, and this year the markets did the same as the Fed delivered a big boost this week, and we'll break down what that means and share some of the forecasts for the coming year on this week's Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. And as we're still catching up from the government shutdown, at least as far as the economic news, and some is still yet to be released, the Fed had their December meeting this week, and they didn't feel inhibited by the lack of data. In fact, the Fed cut their benchmark interest rate by another quarter point on Wednesday, as you undoubtedly have heard by now. And the interpretation in the media was that this might be it for now. The Wall Street Journal said that it, quote, signaled it may be done for now, end quote. But reading into the remarks of Jerome Powell and the Fed statement further, neither I or I think the stock market agree with that, because the markets took off in the afternoon and they closed sharply higher. They are interpreting this as a potential pause for now because there were two votes against this cut, along with a third one that wanted a bigger cut. And the article in the Journal went on to say that progress on inflation had stalled, but that is not what Jerome Powell said. Powell started out his statements by saying, quote, near-term risks for inflation are to the upside, while risks to employment are to the downside, end quote. And he indicated further that the risks remain balanced, as he continued to say. So you might take that alone at face value and think that this could be it for now or not. But key here in the phrase near term, because later on in the conference, he went on to say, quote, if you get away from the tariffs, as the real inflation rate is actually in the low 2%, end quote, which would indicate, since he also said if there are no new tariff announcements, then inflation on consumer goods should peak in the first quarter next year. Well, then that would be at about the Fed's goal of 2%. By then, and the balance of risks we see now between risk to the labor market and risk to inflation upside are expected, or would be expected by that, to shift to the labor side, and we should then anticipate further cuts. That's the big statement from Wednesday's meeting. It's not a foregone conclusion, as there could be more tariffs or other disruptions to supply or other reasons that inflation could persist or pick up. And that was echoed by a global outlook report from J.P. Morgan that I'm going to get into much more later on in the show. But within it, they said that, quote, we maintain our long-held view that global inflation is unlikely to return to central bank targets without a period of subpar growth that would lead to a softer labor market, end quote. So I'm not leveraging up to this path that inflation will evaporate here miraculously in the first quarter and that the Fed can bring us then back to full employment, but I'm saying that's the scenario that Powell was making the case for. In fact, to steal a bit from my focus on that J.P. Morgan report later on, they went on to say that they expect U.S. inflation to remain sticky, and they are pricing in total rate hikes of 50 basis points in the coming year. And not too far-fetched, but it's not what the market sees today. And it's a bit harder to imagine when the Fed gets some new dovish members added. Jerome Powell is going to be gone in May. But these new members are going to come in, and they would have to be forced by obvious inflation pressure to hike rates instead of cutting them further, which is certainly what the committee is going to be stacked with in the coming year. Now, I think I've been generally more hawkish on rates than some, arguing that the neutral rate is about here and that if the economy is indeed warming up, then that would argue that labor wouldn't need the support of further cuts. So don't take this all to mean that I think we're on this glide path to a long series of continued rate cuts here. But this perception I was reading in the press was very different than what I heard from the Fed, what I was seeing and what they were saying, and what the market was reacting to also. For what it's worth, the Fed's dot plot, the projections they put out there, disclosing where their various mines were, now indicate one more cut in the coming year, but the market is pricing in a 75% chance of a cut in January versus a 68% chance they had cooked in before this week's meeting and disclosures. So you can see it contradicts the headlines, but there's a backlog of data coming out soon, as well as I mentioned, changes to the Fed makeup itself. And they are going to be reinforced with those more aligned with the current administration's wishes for lower interest rates. So I'm going to take the under right now and favor a bit more of more cuts and sooner cuts than what some of these pundits are forecasting right now. And while the Fed doesn't give us specific guidance on where this so-called neutral rate actually is, Powell did say that they are now inside the broad range of estimates at the table for that so-called neutral, that balanced policy rate. And he said that they're within the higher band of those estimates. So they are about there, and the argument against further cuts would emanate from that department where, hey, if we're balanced here, if inflation isn't mellowing in the first quarter next year, well, they're already at the neutral rate or just about it. So unless jobs get uglier quickly, that would argue against further cuts. However, while this meeting resulted in what many are referring to as a hawkish cut, it certainly, I guess, wasn't at least as hawkish as feared. So while it didn't burst open the door to numerous cuts, it was less bad. In their reaction to the results, the analysts over at Goldman Sachs emphasized that Powell said they believe that payroll growth is being overstated by 60,000 jobs each month, double what the Goldman Sachs estimate for the exaggeration is in the data. And this means that the modest gains in payroll growth this year would actually be adjusted to negative, and that would open the door for more cuts. Now, while Goldman Sachs also called it a hawkish cut and pointed to the two dissenters against the cut, they point out that there was less of an emphasis by Powell on a wait-and-see approach, and they expect the Fed to provide two cuts in 2026, albeit not until March and then in June. So to them, a January cut would be a pretty dovish surprise, as it is to much of the market, and would expect to give a good boost to equities at that point. So the bottom line for monetary policy this week is the Fed did as expected, but while they delivered a balanced statement, and it's widely considered this hawkish cut, which would mean that they are maybe at a pause point here, they left room for interpretation, and they were less hawkish than the street had priced in before the meeting. The first quarter next year is expected to deliver strong growth, but if it also brings this continued and maybe weaker labor environment along with maybe benign tariff news, as the year-over-year effect of those tariffs should be falling to the wayside, well, then the door is open for a potential cut in the first part of the year, maybe in January, with the general expectations for two cuts during the year, and a third one earlier in the year would generally be well received as long as it's not in the face of a really badly deteriorating economic landscape, which now here as we close out this year doesn't imminently appear to be in the cards. Now, while job growth has indeed stalled, the folks over at Strategis pointed out this week that they have never recorded a recession while corporate profits were rising as they are today. And the labor weakness is coming from just tentative investments from most businesses across the economy, which is likely to improve next year. It's a landscape where labor may continue to stagnate, but businesses are generally doing well, allowing for a more accommodative Fed, fueling additional growth. And that's almost a Goldilocks scenario, and one that would certainly be good for the markets. That being said, I'm going to slip into a quick break here, but when I return in a moment, I'm going to bring back more on what's actually powering the economy and the markets into the next year. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
AI stocks still dominate the market, but valuations are almost back to dot-com bubble levels. How should you balance participation with diversification? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. As I mentioned earlier, JP Morgan put out an extensive global 2026 outlook report this week, and the crux of it is basically that the economy has good potential to actually slingshot into this next year as the AI investment continues to accelerate. Lending becomes more readily available and cheaper with these lower rates. And also non-AI related CapEx returns after largely being stagnant or stalling at least in 2025. But as business caution fades, as mentioned in JP Morgan's outlook, that will create an acceleration of business activity, albeit along with the continued threat potentially of inflation. And if inflation can remain under control, and the refrain today is revolving around the pain the consumer is feeling on prices, if inflation doesn't head higher, it's a good recipe for lower interest rates and the markets continuing higher in the coming year. While the final outcome remains years away to see if these trillions being invested in AI will deliver a good return on all this investment, the investors themselves, these hyperscalers and the big corporations, and those driving so much revenue into the chip makers and into the database providers, the power producers, and so on, the hyperscalers themselves are pot committed at this point. And there's little evidence to suggest for a case where they're going to just change course suddenly and back away from all these capital spending plans, which they've already committed to. So short of some kind of unexpected breakthrough in hardware that changes the way things are being done, and there's no sign of that occurring. There's nothing really kind of emanating about to just kind of solving the riddle and then that everything changes. Well, these investments are going to continue to ramp up further in 2026, pushing the demand for chips and hardware and infrastructure. Now, somewhere in my mind, there is this memory of the late 90s and this huge build out of the fiber networks, where companies were laying these endless amounts of fiber to provide the bandwidth for this burgeoning internet we were creating. They're laying it out all across the nation, along the railroad tracks, also underseas. And that was ultimately proven to be well overdone and beyond what was necessary because of advancements in data compression. But I can't find a similar threat that correlates to what we're seeing now. Anything being suggested in development today, really. Shoot, even at a recent conference, and I saw it mentioned again today, Elon Musk and Jensen Huang were chatting about the potential for these data centers to start being built and managed in outer space, where they'll have plenty of solar power and cooling available. And that's a bit far-fetched today. But I don't expect anything like that to remove the need for what's currently being constructed and licensed and procured today. Anyway, JP Morgan is a bit more reserved in their projections. As I mentioned, their view that the Fed will be fighting inflation still and will have to hike rates, they say, actually, in 2027 in their view. But they're more and more bullish on stocks for reasons I've mentioned already, but both that the broader business community is going to be less reserved in their capital expansion plans beyond the tech companies, the average businesses and organizations in this country that aren't AI related have been kind of taken a wait-and-see approach, but they're going to participate. And J.P. Morgan feels strongly that the tech side is going to continue to rock and roll. In fact, they expect that, quote, positioning will resemble 2025 with new extremes in crowding, record concentration, and AI will continue to be the key theme that drives performance, end quote. And they went ahead and they put a $7,500 target on the S&P 500 for the year. And that's roughly 10% higher than today. But they also say that if the Fed eases more than they expect, they could expect to see the S&P reaching 8,000 for next year, or gains of about 15% for 2026. And I think that bubble talk is going to continue. And like we've seen this year, we'll see some dramatic volatility at times when the air is let out of the trendiest of tech names. But really, I've said the bubble isn't about the spending that's driving the tech build-out for this next year, as that's hard to imagine halting suddenly amidst these existing plans for deploying capital, procuring the equipment, and the physical efforts of building it out that are underway. But the real bubble considerations are further out on the horizon to see if they actually discover that so much money was spent in these few years that isn't actually producing enough return. Howard Marks put out an article in the Financial Times this week, and while he is not a perma-bear by any means, he is definitely, I would say, a pragmatist. And the article addresses his thoughts on a bubble. That was the headline, are we in an AI bubble? But ultimately, he too didn't claim that there was one here, at least not one that he expects to burst anytime soon. But instead, he was a bit more skeptical of the long-term benefits, but acknowledged that part of the dynamic is that the technology behind all of this is already being employed, radically improving productivity in many areas. And while I can keep saying that they may not achieve a return on this investment, we've only just begun with this deployment of the earliest iterations of AI, really. And the evidence points mostly that the effects are profitable. The revenue from these early iterations is accelerating. Over at Deutsche Bank this week, their 2026 outlook also included this 8,000-point price on the S&P 500, and they similarly noted that the U.S. business growth would accelerate as the trade uncertainty fades. Now, you may recall me repeating over and over, starting with the fourth quarter of last year, that I expected this year to be characterized by initial headwinds from the expectation of tariffs being applied, which this past April proved to go well beyond anyone's expectations, only to later see them prove to be actually much more moderate than was threatened in April, and that we'd then transition into a period of government support for the stock market, for the capital markets. We would see lower regulations, what's anticipated to act as a major stimulus in the next year with the effects of the BBB, and also an increase in M&A activity, which we're already seeing popping up more and more in the markets, albeit with some unprecedented, I'll say, government participation in the details of some of these merger deals that are getting proposed. Deutsche Bank also points to attractive dynamics unfolding in Europe, and we've talked about how J.P. Morgan had recently also been emphasizing a boost in Europe, in the European markets, that a stronger euro would contribute to that, at least from the perspective of an American investor. But Deutsche Bank also went on there focusing on expected growth coming from Germany, where they see, quote, after years of stagnation, positioned for one of the most meaningful rebounds amongst major economies thanks to newly unleashed fiscal stimulus, end quote. So they have a greater focus on the German economy outpacing us all. And they too expect 2 cuts from the U.S. Fed in 2026. So another case, another example that a result in 3 cuts or more would be a surprise to the upside. And they expect AI to continue to dominate the markets, and they put out an earnings target for the S&P 500 of $320, which means that their target goal for the index itself of 8,000 is 25 times that earnings number. And that's a result that seems well within the scope of what the markets have been providing these last few years. But it's a year or two from now when we'll have to get more serious, I think, about the narrative about the quality of those earnings, what that $320 really represents, as most of it right now is being plowed back into capital spending, which hopefully they'll see a return on, plus we're seeing a lot of additional funding coming from enormous amounts of new corporate debt being plowed into cap spending. We're not really seeing huge dividend increases and large share buybacks in many cases. You are seeing it somewhere, but right now, this earnings increases is being invested back in, so you need to get that return on capital. So as we look further out on the horizon, we too have to get serious about needing this return on capital investment when we start thinking about 27 and 28 and the valuations we may be asked to pay for some of these stocks as we get into 2026. If it gets too far ahead of itself, if the first half of next year is particularly strong, then we're going to have to really think about what are we buying for in the future. But right now, I think the stage is being set for it to be a strong year, and I remain optimistic. So as we close in actually right now on Dow 50,000, we might get there right before the end of the year. That's less than 3% from where we are today. But as we close in on Dow 50,000, that's it for me this week. And I have one more podcast myself to do before the end of the year. And maybe I'll use that, without committing to it, that I'll use that to reflect backwards a bit and talk about what I remember from when we were trumpeting the closing in on Dow 10,000, which some were calling a ceiling at the time, said it would be hard to go far past Dow 10,000. And that was in March of 1999 when we first got to Dow 10,000. And the Dow, as well as the S&P 500, did stall pretty well after that. It actually got to about Dow 11,000 and change to start the year 2000, and then proceeded to return as a total return of just higher than zero per year for the next 10 years. And the markets may have echoes of that, echoes today of what we were seeing in the markets in 1998 and 1999. So we will remain prudently cautious as well as optimistic and opportunistic. But for now, for the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.